Environmental litigation is reshaping 2026 earnings forecasting. Mid-year earnings forecasting used to revolve around demand signals, interest rates, and commodity volatility. In 2026, environmental litigation is increasingly acting as a structural forecasting variable. Several multi-billion-dollar cases over the past 3 years demonstrate how environmental exposure can expand rapidly, widen reserve ranges, and complicate capital allocation decisions. For leaders preparing financial guidance, the question is no longer whether environmental litigation exists. It is whether existing models adequately account for its scale and unpredictability. PFAS settlements reset the liability baseline. The clearest financial signal comes from PFAS litigation. In 2023, 3M agreed to resolve claims from U.S. public water systems alleging PFAS contamination. The settlement has been widely reported at up to $12.5 billion in nominal value, structured over 13 years. In its investor materials, 3M described the commitment as up to $10.3 billion pre-tax present value. That distinction, nominal versus present value, is precisely the type of modeling variable finance teams must scrutinize. Shortly afterward, DuPont, Chemours, and Corteva reached a separate $1.185 billion settlement addressing similar public water system claims. For CFOs, the takeaway is not limited to chemical producers. The settlement scale has recalibrated what reasonably estimable liability can mean under ASC 450. Climate litigation is advancing in state courts. Climate liability litigation has also matured beyond procedural dismissal battles. In 2023, the state of California filed suit against major oil producers, including ExxonMobil, alleging climate-related deception and damages. Separately, Connecticut's Attorney General announced in 2025 that a court denied ExxonMobil's motion to strike a consumer protection lawsuit alleging misleading climate communications. In Honolulu, climate litigation against oil companies has survived efforts to move the case to federal court, with the U.S. Supreme Court declining to intervene, allowing state proceedings to continue. These developments matter because they increase the probability that climate cases reach evidentiary and damages phases rather than ending on jurisdictional grounds. For finance leaders, advancing procedural posture elevates litigation probability assessments. Water and contamination liability remains a long-tail risk. The Flint, Michigan water crisis resulted in a $626 million civil settlement approved in 2021, with implementation milestones continuing into 2022. While that matter is largely resolved, it continues to influence municipal liability standards and infrastructure litigation exposure nationwide. In parallel, utilities across the U.S. have disclosed substantial coal ash remediation obligations, leading to asset retirement obligation adjustments measured in the billions. These cases share a common feature. Liability unfolds over extended time horizons, often beyond traditional quarterly forecasting windows. Insurance recoverability is less predictable. Environmental liability insurance is tightening. Carriers have added PFAS exclusions, raised deductibles, increased underwriting scrutiny, limited coverage windows for emerging contaminants. In several PFAS matters, policyholders and insurers are engaged in secondary disputes over coverage applicability. For finance teams, this creates a layered exposure problem: primary litigation uncertainty, insurance recovery uncertainty. Forecast models that previously assumed predictable insurance offsets may now require stress testing. Reserve accounting is becoming more dynamic. Large settlement frameworks demonstrate how liability ranges can shift once bellwether rulings establish precedent. Key variables affecting reserve estimates include expansion of plaintiff classes, evolving scientific standards, state-level regulatory divergence, judicial rulings allowing cases to proceed. Reserve adjustments mid-year can alter earnings narratives quickly. Even modest upward revisions, when disclosed late in a quarter, may influence analyst models and investor confidence disproportionately. The reputational cost of a reserve revision often exceeds the accounting charge itself. Exposure is diffusing across sectors. While chemical manufacturers and energy producers carry primary exposure, secondary defendants are expanding. Airports and transportation operators linked to AFFF use, industrial site owners with legacy contamination, consumer product companies facing disclosure claims, municipal water authorities. Diversified enterprises must evaluate environmental litigation risk at the business unit level. A single division's liability can distort consolidated forecasts even when core segments remain stable. Why this distortion is emerging. Now, mid-year forecasting is particularly sensitive to environmental litigation trends for three reasons. Reserve reevaluations often occur ahead of Q2 earnings updates. Insurance renewals may reset premiums and exclusions mid-cycle. Capital allocation decisions, including M&A, infrastructure upgrades, and debt issuance, rely on updated contingent liability assessments. The litigation environment in 2026 is not defined by a single catastrophic verdict. It is defined by cumulative unpredictability. Environmental litigation is behaving less like a discrete event and more like a volatility overlay. The strategic question for finance leaders. The financial impact of environmental litigation is no longer confined to legal departments. It intersects with disclosure strategy, debt covenants, insurance structures, capital planning, investor relations. Companies that model environmental exposure as static risk may find mid-year guidance overtaken by legal developments. Those that treat litigation trends as a dynamic forecasting input, revisited alongside commodity, regulatory, and macroeconomic assumptions, will be better positioned to preserve earnings credibility. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.